Hi, welcome to Let's Talk Bonds, the weekly podcast from INR Bonds. I'm Arjun Patsati. And in this podcast, we will talk about whether investors should look at equities, where the prices have fallen substantially, or bonds, where the prices have fallen and yields have risen. That is, returns on bonds have gone up also substantially, which is a better investment to do, given that both have fallen in terms of prices. And with investors will be looking for answers. And in this podcast, hopefully, you'll get some answers into this question for investors and financial advisors. Before that, not forget to download our app, the Quick Invest by INR Bonds, which is the best platform for bonds and for bond investments by investors and for financial advisors to showcase bonds for investments for their clients' portfolios. The bonds are available to you with the best, most information, best transparency, the curated list based on our own proprietary risk score and the level of returns the bonds are offering. And needless to say, the best in app investment process, completely supported by our experienced team.
It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.
Coming back to the podcast, we equities have really fallen sharply, and typically when equities fall, there is a huge amount of risk aversion by investors because it is highly eyeball grabbing. And given that many investors, retail investors, have embraced equity markets in the last couple of years, they have seen a substantial fall in their value of their investments. Having said that, even in the bond prices have fallen substantially, but really don't feel it. Only the returns have been much lower. So all the traditional products, including mutual funds and fixed deposits, have given returns that are about 3 to 4% less than inflation, which is not a good thing for investors, obviously, given that inflation is so high. So where do you invest? Should the investors look at equity markets now, given the prices have fallen substantially, or should they look at bonds where the returns are higher? Now, just to take you through the options available on the fixed income markets, you have now 10-year GSEC, which is at 7.5%. The same 10-year GSEC was at 6% last year. Then you had the ETF, which is a Bharat Bond ETF, which is the mix, index of all PSU bonds. That is again at 7.7%. And this was at 6.7% a year ago. You have then 5-year bonds and the state development loans, 5-year NBFCs and trade state development loans, all are around 7.5 to 7.7, 7.8%. And all these were again at 1% below last year. So clearly, yields have gone up, returns have gone up to some extent. Banks have raised fixed deposit rates, but not by much. They're still at very low levels. Many of them still below 6% or 5% also. Many. Some NBFCs have offering higher yields, returns on fixed deposits. But now their returns are still much lower than where inflation expectations are. And RBI has forecast that inflation is expected to be at 6.7% for this year. And typically, inflation exceeds that forecasted rate. So, the question for investors is: should you look into invest in bonds, which is yielding say 7.5, 8%, or if you go to slightly lower rated bonds, 8.5, 9 or 9.5. Tata Motors Finance Solutions came out with a perpetual bond, 10-year call option at 9.3% coupon. Now, is that an attractive option? There are many bonds available in a 9% range, ranging from 1 year maturity period of 1 year to even 3, 4 years. Are these bonds good? Or is it better to invest in, say, an SBI perpetual, which is can come into 4 or 5 year bonds in a level of, say, again 7.5 to 7.8%? are all these are better options? So clearly, the first question financial advisors will ask an investor, or an investor will ask themselves, investors will ask themselves is, will equities give 7.5% to 10% returns in 1 year? And if the answer is yes, then clearly equities do find a better favor, because the fact that uh, they have in 1 year, over a period of 1 year, you pay still long term capital gains tax rather than the short term tax. And bonds don't have that benefit. They have a 3 year lock in if it's through a mutual fund, any other structure. So if equities can give 10% in a year, if that's expectations, then more weight should be towards equities. But if equities is not expected and can be volatile for this year, and maybe even fall another 20 to 25%, then bonds seem to be a better option, where there is clearly a steady return of around 7.5%, definitely, and maybe much higher if the right bonds are selected uh, by the investor. Um, Now, with the prices have fallen substantially on equities, many investors have seen their portfolios fallen values sharply. So that prevents them from taking that that risk they want to take in equities, even if the markets are looking down. But having said that, in some ways, if there is a case for equities, then some money has to be put into equities. But maybe bonds can help that money in equities. For example, investors can invest in bonds and use that interest payments to invest in equities. Such kind of portfolio strategies, or cash flow planning, can help uh, determine, increase their returns with a lower level of risk, because capital loss is still protected through the bond investments. But having said that, let's look at the outlook for both markets. Both markets outlook are not looking very good. So with equities now looking at higher interest rates, there's a lot of issues on the global macro front. Central banks are pulling out liquidity, and a lot of excess money has gone into equities. So now, when that is coming out, then there could still be a lot more volatility, and we may not see the markets really jumping up. So there could be some trading place here and there, but not many investors are into trading. Having bonds too, they're still facing a lot of headwinds in terms of macro, then credit also, and with equity markets down, a lot of issuers that have depended on equity markets for bond fundraising may not be able to issue bonds further, and may find it even difficult to service their debt. So again, investors have to be careful. But if they select the right profile of issuers, the right bonds at the right level, then there is a certainty of returns, and maybe the certainty of returns could help investors to tide over the current period of volatility, and then get back when equity markets stabilize, and get their feet up again on to invest in equities. Um, so that just the takeaway from here is that investors and financial advisors will have to have an outlook for at least 10% returns over the next 1 year in equities if they have to beat bonds. And if they don't have that outlook, then bonds seem to be a better option because of the steadiness of cash flows. But again, choosing the right bond is going to be the most important. And the bond yield also has to beat inflation by a margin. Thank you very much for listening in to the podcast. Do not forget to download our app, You Can Inspire in our bonds, and follow us on Spotify, Apple Podcast, Amazon Music, and YouTube. Thank you very much.